Well, good evening, comrade.
Welcome back to our session, our YouTube session. So, in the previous sessions, we have done cash flow statement and our financial statement analysis. So today I want us to look at consolidation of financial statement in what we call the separate financial statement. Uh, that one we're going to capture IS 27 and IS 28, that is consolidation of subsidiary companies and also associate companies. Briefly, you know that consolidating subsidiary companies, you apply what you call the full consolidation method. So you're going to consolidate the line by line basis of financial reports by each separate financial statement one. Then when it comes to associate company, we are going to apply the equity method in consolidating it. So in solving that, I'm going to answer a question here, solve a question here. I'd done it before, but my file was somehow corrupted. So I just come to review it for the sake of recording. But let me just read the question. It was financial reporting intermediate level, April 2023. Question 2. So I'm reading the question. I hope you can view it, but I will also imply it in your screen. Question 2. River Limited operates a fast-moving goods subsector. During the year ended 31st March 2023, River Limited expanded its operation by acquiring a controlling interest in Sai Limited and a significant influence over the activities of Tutu Limited. The following draft financial statement for the year ended 31st March 2023 relates to the three companies. So, statement of profit or loss for the year ended 31st March 2023. You can see them for for the three companies. The River Limited, which is the parent company or the holding company. Then the Sai Group, Sai Limited, which is a subsidiary company which was controlled, and then Tutu Limited. So these are the financial statement information. There you can see the revenue for the three companies, cost of sales, gross profit, distribution cost, administrative expenses, profit from operations, investment income, finance cost, profit before tax, income tax expense, and profit for the year. And then you can see the statement of financial position again for the three companies. The River Limited, Sai Limited, Tutu Limited. Assets, you can see non-current assets. There's property, plant, and equipment, and investments. Current assets, you can see inventories, trade receivables, financial assets at fair value through profit or loss, cash and bank balances, then total current assets, the total assets. And then equity and liabilities, you can see there's equity, ordinary share capital, share premium, retained profits, and total equity. And our current liabilities, you can see the 12.5% loan notes and deferred tax. Then current liabilities, trade payables, and current tax, then total equity and liabilities. Additional information. On 1st January 2022, River Limited acquired an 80% ordinary shareholding in Sai Limited for a cash consideration of 1.1 or 1,100 million. The fair value of assets and liabilities of Sai Limited were equal to their carrying amounts at the date of acquisition. But 2. The group policy is to measure the non-controlling interest at their proportionate share of net assets of the subsidiary at the date of acquisition. 3. On 1st January 2023, River Limited acquired an 80% ordinary shareholding in Tutu Limited for a cash consideration of 500 million shillings. During the post-acquisition period, River Limited sold goods to Sai Limited for 300 million. River Limited reported a 20% gross profit margin on this sale. Half of these goods remain in the ending inventory of Sai Limited at the year end of 31st March 2023. 5. Included in the trade receivables of River Limited was 80 million shillings due from Sai Limited. In the books of Sai Limited, an amount due to River Limited was shown at 60 million because Sai Limited had remitted 20 million, but River Limited had not recorded the remittance. 6th, on October 1, 2022, River Limited sold an assembly plant to Sai Limited for 400 million, reporting a 25% gross profit margin on the selling price and netted off the profit against its cost of sale. The group charges depreciation on plant at the rate of 20% per annum on cost on full year basis in the year of asset purchase and none in the year of disposal. 7. Impairment test carried out on 31st March 2023 revealed that neither the goodwill on acquisition nor the investment in associate had been impaired during the year. 8. None of the group company paid dividends during the year to 31st March 2023. Required consolidated statement of profit or loss for the year ended 31st March 2023. And B, consolidated statement of financial position as of 31st March 2023. A total of 20 marks. So now, this is a group account, or sometimes we call them the consolidated financial statement. So there are interesting things here. The first thing before you consolidate a question, you must look at the period of consolidation, or at what period did these companies operate as group companies. So if these people are preparing their financial statements, their year is ending on 31st March 2023, and they acquired, the parent company acquired a subsidiary company on 1st July 2023. You realize that this company is only operated for 9 months, that financial year that was ending, because if you are ending financial year in 31st March, it means you opened it in 1st April 2022. So now, but it was acquired on 1st July. So 3 months in that previous year, they had not acquired this company. They're not operating as one. So you must ensure that you apportion the revenue items or the income statement item to the proportion of the time of post-acquisition. So from revenue, all revenue items, you're going to apportion them with 9 months. Again, if you come to acquisition of this Tutu Limited, which is an associate company, it was acquired on 1st January 2023. So from 1st January 2023 to 31st March 2023, that's a period of 3 months. So they only operated as one for 3 months. So you apportion for associate company, you're going to apportion only for 3 months. For Sai Limited, which is a subsidiary company, you're going to apportion for 9 months in consolidating it. Again, another thing, you realize that this company had no company had paid dividend, but I'm seeing investment income in this income statement. So it means this investment income did not arise from intercompany, because anytime a company acquires shares of another company, when that acquired company pays dividend, the majority of its dividend go to the parent company because it's controlling it. Like now in this case, it's controlling 80%. So the parent company becomes the main shareholder of the subsidiary company. Of course, the remaining with the non-controlling interest, those who cannot control any decision making in the AGM, they're only controlling 20%. So you're going to apportion that one. There's also post intercompany sale of goods. Of course, anytime you see this intercompany sale of goods, you think of the unrealized profit, because you cannot make profit from yourself. Since these companies have decided to become one, if you sell goods to another company, you don't make profit from it, because now you are one family. And goodwill, of course, we are not going to compute goodwill for Tutu Limited, because you don't always consolidate goodwill of associate companies. We only compute goodwill for associate company. In any case, there's impairment test, and the goodwill on acquisition has impaired. So in this case, there was no impairment, so we don't need to struggle computing the goodwill for associate company. But we're going to compute the goodwill for subsidiary company. The intercompany sale of fixed asset is also here. Anytime you hear intercompany sale of fixed asset, you think of excess depreciation, because they always state those fixed assets on profit, not on cost. So you find that somehow the value of this fixed asset is overstated because of the prices of markup that they want to charge whenever they sell that company. So you also have to eliminate that excess depreciation from the consolidation. So we did with our workings. If I start with my working one, I told you I've done this question just for the recording purposes. Our working ones, we checked on the period of consolidation or post-acquisition period. We realized that it's 9 months for Sai Limited and 3 months for Tutu Limited. And then we came up with the goodwill computation. They say that they acquired this company for 1,100,000,000. So you can see it here. The goodwill here is 1,100,000,000. And then the number of shares acquired for this company, for the SAI Limited, the equity, the net assets acquired, of course, those are equity. The equity for SAI Limited was 500. You can see the ordinary shares 500, the share premium is 200. And then there is pre-acquired retained earnings. The profit that this company had made before it was acquired is also part of the net assets that you charge. So now we know that the profit, the retained earnings for SAI Limited in the separate financial statement was 800. But the profit that made during the year, they reported during the year they made a profit of 400. So the profit balance brought down, or the profit they made in the previous years they operated, will now be 800 minus 800, which is the total profit as at 31st March 2023, and also the profit they made during 2023 alone. So the difference was 400,000 for the previous period, or for the balance brought down. But now, even this 400 million that they made this year, for 3 months, they had not acquired. It was pre-acquired for 3 months. So the post-acquisition was only 9 months. So I've apportioned it and given 9 over 12 of 300,000, of 300 million. And then pre-acquired was also 3 over 12, 400. So the total pre-acquired retained earnings is the profit balance brought down plus 100 million, which was 3 months before acquisition. The total pre-acquired retained earnings was 500 million. So I come and add it to part of the equity items that were acquired before, that this company had before it was acquired. So the net assets acquired at the date of acquisition, the net asset was 1,200 million. And of course, since they were controlling 80%, so you get 80% of the total equity before acquisition, you get 960. Then if you get that, if you deduct that from the purchase consideration, you're getting goodwill of 140. So this is how I came up with it. I added 500 plus 200 plus 500, which was pre-acquired. I get 1,200. And then times 80%, 960. So 960, I deduct it from the purchase consideration. I get 140. But that's for fast working. It's not a challenge to compute goodwill. This kind of goodwill computation is called the partial goodwill computation. We always have the full goodwill consolidation, or the full goodwill method, where you are given fair value of the non-controlling interest. In this case, we are not given the fair value of those who are not controlling decisions in this company. Now, then investment in Tutu, which is an associate. How to get investment in Tutu? Just get the purchase consideration of Tutu Limited, which they told us to be 500,000. You can see it in the question here, in note number 3. They said that on January 1, River Limited acquired 40% ordinary shareholding in Tutu Limited for a cash consideration of 500 million. So 500, then you get share of post-acquisition retained earnings. Now, the retained earnings, the profit that Tutu made during that year was 200 million, as you can see here. And then, of course, I told you earlier that they only operated for 3 months to the end of that financial year. So you get 3 over 12 of the total, because this 200 is for their all 12 months. So you get the portion of 3 months, and then times 40%, which they were influencing. So if you do that, you get 2%. 2 million, sorry. You get 2 million. You add it to the purchase consideration, you are getting a total of 502 million. That was working 2. Now, working 3, on the other end, we checked on intercompany trade of goods. And I told you intercompany trade of goods, what you check is the unrealized profit, the profit they made when they sold goods to each other, because there could be a synergy that led to these companies joining hands or being acquired. Now, unrealized profit, they told us in note number 4 that during post-acquisition period, the River Limited sold goods to Sai Limited for 300 million. River Limited reported 20% profit margin on this sale. Half of these goods remained in the ending inventory of Sai Limited at the end of the year 31st March 2023. So now the value of the goods I sold was 300 million. So how you get unrealized profit is the value of those goods they sold. You must always ensure that this stock, the inventory that they sold, they didn't state it at cost or they stated it at selling price. So if they stated at cost, if they stated these goods at cost, of course, you'll have to apply markup in getting unrealized profit. If the selling price and you're going to apply margin. So if you are given margin and cost, you have to convert that margin to markup. If you are given cost and then you are given a margin, you have to convert that markup to margin and vice versa. So how to get the unrealized profit? I always call it URP. You get 300 times 25%, which is the margin times the goods that remained in stock at the end of the year. So they say that half of the goods remain in stock at the end of the year. So that's how we got it. 300 times 0.25 times a half. So you get that 7.5. That is our URP. Now, we always eliminate this profit because it's unrealized. So anything unrealized, you eliminate it when you are consolidating this financial statement. So you eliminate it by splitting it to the one that is going to the group and the one that's going to the non-controlling interest. So the ones going to the parent of the group, you get the 80% of it. So this is how I did it. That's 7.5 million times 80%. I got 30. And then the one that is attributable to non-controlling interest was that 7.5 times 20%. I got 7.5. So that's how you get unrealized profit. In any case, there is intercompany sale of goods. Now, we also came to compute excess depreciation in note number 6, which we are told that on 1st October 2022, River Limited sold an assembly plant to Sai Limited for 400 million, reporting a 25% margin on selling price and netted off profit against its cost of sales. The group charges depreciation on plant at the rate of 20% on cost on full year basis in the year of asset purchase and none in the year of disposal. So now, here again, we are how to get excess depreciation. You find the value that was stated in that asset that they sold internally, of course, times the rate of depreciation times the markup that they charged. So this is how I got it, 400 times 25% times 20%. I was getting 20 million. You can see it there. I was getting 20 million. After that, I came to find the group retained earnings or the group retained profit. Now, if you bring the profits made by all these three companies together, those are operating as group. So group retained profit, I brought the profit from the profit that was made by River Limited. That profit, you can see it is 20 million. Then I added the profit made by Sai Limited. Sai Limited, you only add post-acquisition, share of post-acquisition profit. And we realized that the share of post-acquisition profit, we had computed it earlier here in our working up here, and we saw that it was nine months over the 12 months times what they made, which was coming to 300 million. That was the post-acquisition profit for the 9 months they operated to the end of that financial year. So again, I get share of it because the parent company was only taking 80%, was controlling 80% of shares in this company. So it was 80% of 300, which was 240. And then Tutu Limited was again getting, if the profit that Tutu Limited made here was 200 million, was 200 million. So, and that's for that year, but it was only acquired for 3 months. So to the end of that financial year. So I got here 3 over 12, 3 over 12 times 200 times what they were influencing, which was 40%. I was getting 2 million. So I added it. I found 2 million. Then there's also unrealized profit, which I have to eliminate. And I'd splitted it into two. You can see the unrealized profit that was attributable to the parent, and also the unrealized profit that was attributable to the NCI, or the non-controlling interest here, which I was getting. So at the point of group, it was 30%. And then also, of course, I added excess depreciation. Why am I adding excess depreciation? I'm adding excess depreciation because the depreciation charge of this asset, the value that we charge that rate was in excess of the markup that it was sold at for. So we have to eliminate. So in other words, they over-deducted, they overcharged depreciation. So anytime there's an error of overcast, it's like an overcast or overstated depreciation. So to always add overcuts, you always ensure that you restate it back. If it's an expense, you add it back. It's an income, deduct it. So since depreciation is always an expense, in any case it's overstated, you are adding it back to the income or adding it back to the PP. So that's why I'm adding excess depreciation. So I'm getting the group retained earnings to be this figure. If I just add with you, 1020 plus 240 plus 2 minus 30 plus 20, I'm getting 1252. Then lastly, the last working I did was the non-controlling interest. Non-controlling interest, in any case, you are not given fair value of non-controlling interest. Just get the equities, the total of equity of the subsidiary company. In this case, the total of equity was 1.5 or 1500. So and then I get the percentage of non-controlling interest, which was 20% of 1500. I got 300. And then I eliminated URP at that point. I eliminated the URP for the unrealized profit, which I had computed here in 7.5. So I eliminated URP. And then I'm getting that the net URP, or then the net NCI, or the net non-controlling interest, to be 292 minus 7.5, 292.5 million. So having done that, of course, group account normally does not need a lot of workings, unlike cash flow statement. So then I briefly came to consolidate it. I came to consolidate the statement of profit and loss or loss. Consolidating statement of profit or loss. You have to be very sensitive with revenue items because you have to prorate them in the year of acquisition or in the year of post-acquisition. So if this was my work, this was my question paper, I'm now consolidating the revenue item. You could see here the revenue item was 4190. Of course, for parent, you just add it in full because it has been operating there by itself. Plus the revenue for subsidiary, which was 2600. But this 2600, you have to ensure that you get it. You have to ensure that you get it times 9 over 12 because that's the year they operated. And of course, I must eliminate the intercompany sale. It was minus 300 million, getting 5840. See here, 5840. That's why I consolidate the revenue, the group revenue. And then I can now get the group cost of sales. The group cost of sales. The group cost of sales here, you can see here the cost of sales here was 2730. So 2730 for the parent company. plus 1400 for the subsidiary company. Then you have to apportion it. Again, the way you are eliminating, because you are eliminating it at group revenue and also at group cost of sale. Because anytime you make intercompany sale of goods, one company realize sales, one company realize purchases. So you have to eliminate them both at 2 points. So minus 300. Of course, at this point also, we are going to ensure that we also eliminate the unrealized profit, which we found to be 37.5, and also eliminate the excess depreciation, which was 20 million. And then you get the group cost of sales to be 3497.5. You deduct it from group revenue, you get gross profit, or the group gross profit. So the group gross profit in this case will be 5840 minus the group cost of sales, which you are getting here to be 2342.5. And then you come to other incomes. Other incomes, there was investment income. Those investment income. Now, since these companies, neither of the company pay dividend, because if the subsidiary company pay dividend, of course, then we'll have come across what we call the intercompany dividends, because one of the main shareholders of subsidiary company is always the parent company. Because if you are controlling 80% of the share capital of another company, you become the majority shareholder. So that always will lead to what we call the intercompany dividend. Intercompany dividend is always eliminated. So if I'll do another question where there is intercompany dividend, I'll show you how to eliminate intercompany dividend. For this case, this investment income did not arise from dividend. So we just consolidate it the same way we are consolidating other revenue items. So you can see how I did it. The dividend for the investment income for the parent company, you'll see it was 40 million. For subsidiary company was 20 million. We don't add for associate company because we don't use full consolidation method. We use equity method, so we don't consider them at this point. So of course I did it here for the group investment income, which was 40 plus 20 times 9 divided by 12, which I found to be 55. I disclosed it here to be 55 million. To be 55 million. And then I added it to gross profit. So plus gross profit here. Plus gross profit is just 2342.5. 2342.5. So I could got 2397.5 as our total income. Having done total income, then I came to expenses. I started with the expenses from operations, for the operating cost or operating expenses, which I realized to be distribution cost. I added distribution cost. You can see distribution cost here. 300 for parent company and 200 for subsidiary company. Of course, I have to apportion it. So ensure that at all time you apportion the revenue item that I got here to be 450. And then administrative expenses, you can also admin expenses, 500 for the parent and 400 for the subsidiary times 9 divided by 12. I got 800. So I added those two expenses to get operating cost or operating expenses totaling to 1250 million. Of course, then I deducted it from the total income up there, which was 2397.5. I got to be 1147.5. That difference is giving us what we call operating profit. Giving us operating profit. Then I deducted finance costs. Finance costs, most basically they are interest, either interest from leases, I thought there was a leased plant, or interest from loans. Like I could see there was 12.5% loan notes. So probably that's where the finance cost came from. Again, interest we just consolidated the same year consolidating these are the revenue items. So interest was 80 plus 60 for subsidiary. This times 9 divided by 12. because I got 125. So 125 I deducted from the operating profit to get profit before tax. And then I also check or consolidated the income tax expense. Income tax expense was again 180 for parent plus 160 for subsidiary. Again, I have to prorate it. So you have got 300. So I arrive with 300 here. And then, of course, I came up with the profit after tax, which was 1022.5 minus that income tax expense. I'm getting 722.5 million. And then also I have to add back the share of profit from associates, the share of profit from Tutu, or what we call the share of post-acquisition profit from Tutu Limited. Of course, I showed it here. Tutu Limited made a total profit. I've done in the working. I can also show you guys here. So Tutu Limited total profit for the year was 200 million times 3/12 because they only operated for 3 months to the end of the financial year times 40%, which they were conducting the significance influence. So if I do that, if I do 200 times 3/12 times 40% or 0.4, I'm getting yeah 20 200 times 0.2, okay, times 3 divided by 12 times 0.4. I'm getting 20. I'm not 2, sorry. I'm getting 20 here. So this changes everything. So 20 and not 2. So if I add 20 here, 722.5 plus 20, I'm getting 742. Sorry, I'm getting 742.5 and not 742.5. So that means I have to, I check that small arithmetic error that I did there. Even in the investment in Tutu, share of profit now we are getting to be 20 and not 2. So if you add it, now investment in Tutu should be 520 and not 502, 520 and not 502. So that was an error that was not affecting trial balance. So, of course, then we find the profit attributable to the non-controlling interest. Profit attributable to non-controlling interest. The profit made by Sai Limited was 400. So I did it here, 400 times 9/12 times 20. So 400 times 9/12 times 20%, because it was controlling 20%. So I'm getting 60. So I did a 60 here. Because of that change, if I do 742.5, which was our profit from operation, minus the answer, I'm getting 682.5. I'm getting 682.5. That becomes our profit attributable to parent. And then I add profit balance go down. Profit balance go down, in this case, we are only going to get to check on profit balance go down for parent, because we realize that all these two companies, the associate company and the subsidiary companies, were acquired in this year, in this financial year. They were not acquired in any previous year. So all their retained earnings balances go down were pre-acquired. So we don't consolidate it here. We don't add pre-acquired retained earnings because they were not operating as one at that time. So the total profit here for River Limited was 1020. So 1020 minus the profit for the year that they made for the year In this case, profit for the year here, you could see it's 440. So the difference gives us the profit for the previous year. So minus 440, I'm getting 580. I've done it here. Then I get 580. So that 580, I add it to profit attributable to parent for the year. So plus 682.5. I'm getting 1262.5. I'm getting 1262.5. So I can change it here because of that change in associate. It will change here also. 1262.5. 1262.5. So that becomes our profit attributable to retained earnings, or what you call the retained earnings. Then very fast, I came to consolidate my statement of financial position here. River Limited consolidated statement of financial position as of 31st March 2023. So we have seen these assets. Assets, you can see non-current assets, which was property, plant, and equipment. Of course, when you come to balance sheet items or the balance sheet item, you don't prorate. You don't say like 9/12. No, you just consider all those figures in full. So here you could see I did for PPE for River was 2070. Then for Sai was 1290. Of course, plus the excess depreciation, which was 20 million. So I'm getting 3380. That's how I wrote it here. So 2070 plus 1290 plus 20, I'm getting 3380. And then goodwill also is an non-current asset under intangible assets. Goodwill on acquisition of Sai, you could see it here is in under working one. Goodwill, I did it here under working one, which is 140. 140 here. You can see I also got 140 here. Working one. Then investment in associates, now it changes because of that small error I did in investment in associate. Associates, it now came to 520 because of this small error here, and not 502. So I have to change that one to be 520 here. 520. So 520, if I add it plus 140 plus 520, I'm getting 4040. I'm getting here 4040. 4040 to be our consolidated, our total non-current assets to be 4040. And then I came to current assets. I also consolidated current assets. Inventory here, you could see it's 530 for parent plus 390. Of course, minus URP, which was 37.5, and realized profit. I'm getting 882.5. 882.5. Then I came also and found trade receivables. Trade receivables, there was also intercompany indebtedness. We're going to eliminate intercompany indebtedness. Minus 80, which was our intercompany indebtedness. So 1030. That's why I got it here. 640 plus 470 minus 1030. Minus 80, I get 1030. Then financial assets through profit and loss. Financial asset through profit or loss. Loss, which was 300 plus 150. Because I just had it, I got 450. You can see it here. Then cash and bank balances. Cash and bank balances was 360. So 360 plus 200, I got 560. If I add all those four items, 560 plus 450 plus 1030, 1030 plus 882, 882.5, getting 2922.5. So 2922.5, if I add it to our total non-current asset, which was 4040 plus 4040, I'm getting here to be 6962. 69.5, 69.62. So I can write it here 69.62.5. 69.62.5. So I can rub this one 69.62.5. I hope it's visible. Then of course I did not change here, so let me change it. I did not change the group retained earnings, so it was supposed to come to 20. So if I do it again, so it should be 1020 plus 240 plus 20 minus 30 plus 20. I'm getting 1270. 1270 here and not 1252. So our group retained earnings will be 1270 because of that error I got when I was computing the post-acquisition retained earnings for associate. Post-acquisition retained earnings for associate. So or profit for associate. So I'm coming now to consolidate coming to equity. So total assets are found to be 6962.5 million. So when you're coming to consolidate equity, you don't consolidate equity of pre-acquisition subsidiary items. So you only consolidate the post-acquisition equity for subsidiary. So you consolidate now. If you look at all these equity items, the ordinary share capital and also the share premium, they were issued before acquisition. So there was no any new issue of shares after acquisition by subsidiary company or by SI Limited. So you only consolidate the equity for the parent. So the equity for the parent, you only check the equity ordinary share capital for the parent. In this case was 2,500. You can see here ordinary share capital 2,500, share premium 1,200. Now when you come to retained earnings, of course we saw that I changed it here. It was now 1270 because of that error. 1270 here. So if I add them, 1270 plus 500 plus 2500, I get 4270. So I should get 4270 and not 4252. 4270. That is the equity attributable to the parent. And of course, I also add the equity attributable to the NCI, the equity attributable to non-controlling interest, which of course I found here. I added 292.5. So if I add 292.5 to that 292.5, I'm getting 4562.5. So this now changes to 4562.5. 62.5 as our total equity now. And then I came here and also did non-current liabilities. Non-current liabilities, we just add them. For 12.5% loan notes, you just add them, which is for parent was 640, for subsidiary or for SI was 480. So I got 1120. You see them there. 12% loan note, 640 plus 480, which is 1120. Then there's deferred tax. Deferred tax, of course, you could see it here. Deferred tax was 260 plus 100. So you just add it in full. Deferred tax. And I'll also show you how to compute deferred tax and current tax and IS-12. So 260 plus 100, of course, that one you get 360. So you get 360, 260 plus 100, you get 260. If I add those two plus 1120, which was to get the total non-current liabilities, I'm getting 1480. That's why I arrived at that answer. Current liabilities, trade payables. I also had trade payables. Trade payables for the parent was 420, for the subsidiary was 330. So 420 plus 330, I'm getting And of course, minus that intercompany indebtedness, as the intercompany indebtedness, I'm getting 670. That's why I arrived at 670. And then current tax. Current tax I also added it here. 160. You can see for parent plus 90. Subsidiary I was getting 250. Current tax 160 plus 90. I got 250. And then if I add those two plus 670, got 920. So now from there I'm now come to get total equity and liabilities. Coming here now to get total equity and liabilities. So 920 was our total current liabilities. I added to non-current liabilities, which was 1480, plus the total equity, which was 4562.5. 2.5. I'm getting 6962. 6962. My space is small, but I hope you can see it here. 6962.5. 6962.5. Maybe I put it here 6962.5. So that is our total equity and liability. So let's check if it balanced with the total assets to know whether we got all these 20 marks. So our total equity and liabilities with accounting equation, you guys know that accounting equation is always assets is equals to capital plus liabilities. So the total of assets should be equal to total equity or capital and liabilities. Because this is a company, capital we denote with the name equity. So 6962.5, which is our total liabilities. Our total assets was the same here also. You could see here it was 6962.5. So it means that we have balanced this equation. We have balanced this equation, the balance sheet balanced. Balance sheet balancing tells us now that we have balanced this equation and we have got it correctly. So consolidating financial statement is not a challenge. It's always one of the easiest things to do. Anytime you are tasked to consolidate group companies. So this is just the basic one. We'll also check one in advanced financial reporting, one that's a little bit complex. But this one is done. So I think we have finished it. We shall see each other off in my next question, in my next solution. So for now, this is done. See you that time.